Let's take a deeper look at corporate profits. I'm Richard Vague with Tycos. Last week, we asked why corporate profits have grown so much in recent years. We saw two main forces at work. First, wages as a share of GDP have drifted down, especially since 2008, leaving more room for profits and dividends. And next, higher net social benefits, the welfare programs that are either lauded or reviled, depending on your point of view. But it is those very higher net social benefits that have added profits to the vast array of businesses that support lower income households. Remember, every government expense is matched by an equal amount of income in the private sector. Money doesn't disappear, so government deficits result in higher household and business profits. This week, I want to pick up where we left off and look briefly at four additional forces: the greedflation debate, the new tariff regime, the AI boom, and interest rates. Let's start with greedflation. Some commentators are convinced that businesses aggressively increased prices to cope with the sharp rise in inflation in 2021 and 2022, but have not reduced prices as quickly as their costs have fallen, thus taking advantage of consumers. While that may be true in some cases, it does not appear true in the aggregate. Raw material prices at their mid-2022 peak were about 21% above 2020 levels, while consumer prices, the amount that businesses charge their customers, were only about 12% higher. So in aggregate, this was a challenge to business profits. Another major factor is the new higher tariff regime, which arguably will reduce business net income. It is only now beginning to impact earnings results, and we should be able to see the full effect in the aggregate numbers in coming weeks and months. We will report that as we see it. Pre-Trump, tariffs on most of the rest of the world were 3%, and the threat on April 2nd, Liberation Day, was that they would rise to 20%. The reality seems to be that they will settle below that at 19% or probably lower, given the sudden reversal of tariffs on many imported foodstuffs Trump has put in place in fear of political repercussions. As for China, pre-Trump, tariffs were 21%, and the threat on Liberation Day was that they would rise to 135%. But at the moment, it seems that they will settle in at maybe 48% or perhaps lower. China's stranglehold on critical minerals and other key items has limited just how aggressive the U.S. can be here. In general, Trump's negotiating leverage over other countries was not as strong as he believed it would be, and we can couple that with the fact that tariffs are indeed putting upward pressure on prices the very moment that voters are protesting higher prices at the ballot box. So it seems like these four factors, wages, social benefit programs, inflation, and tariffs, will have limited variability or change over the near term and thus have limited near-term impact on corporate results. Social benefit programs are under attack, as we see, but the backlash there will be sufficiently intense that we wouldn't expect that attack to be sustained. Tariffs may put upward pressure on costs, but imports are only a very small part of GDP, 14%. So at their worst, that impact will be within bounds. However, there are two other factors that could be very big and make a decisive difference in business profits. The first is a lessening of the massive windfall that has come from the AI boom and related spending. Some analysts estimate that AI spending has accounted for approximately half of GDP growth in the first 6 months of 2025, and perhaps much more. That's an astonishing fact if true. Estimates vary, but AI spending will end up reaching somewhere between 2 and 6% of GDP in 2025. It's a pretty wide range, so analysts have, varying estimates of what is going to happen, but it's big, in any analyst estimate. This has been an unexpected and highly welcome boon to corporate profits. AI spending could very well remain that high in 2026, but we do foresee a big decline here. And even though we do expect AI to bring profound changes to technology, labor markets, and society as a whole in time, we believe that over the short run, stock valuations and AI spending have raced ahead of sustainable levels, and a softening is due. When will that come? It could come at any time. However, we've seen again and again that markets always stay irrational for longer than hard-nosed analysts think possible, and we would not be surprised to see this AI boom continue for a period. But will it persist past 2026, into 2027 or 2028? It's hard to imagine that it will. If not, we're looking at a significant slowdown in GDP, perhaps enough to bring a recession. But if so, there's a saving grace here. Business in aggregate is a huge borrower. Much of that borrowing is short-term and variable rate. So if and when the AI slowdown comes, expect the Fed to aggressively lower short-term rates, and that very act will help salvage business earnings. That's it for this week. We appreciate all of your comments, questions, and support over the last year. If you're not a subscriber, we'd love to have you join our community by clicking on the subscribe button. Thanks.